This week on the VC React podcast, Property Finder hits $2 billion valuation after 13 years. But why do older startups grow slower while newer ones scale faster than ever? Noon is racing towards a $10 billion IPO, but still not profitable. Bold move or pressure to exit soon? Orbii raised a $3.6 million seed round to build the credit trails for SME lending in MENA by providing banks with the tech they lack. Would this challenge the existing SME lending startups? And finally, a fresh $200 million growth and pre-IPO fund just launched. But is there really enough growth stage pipeline in MENA to absorb all this capital? Let's get into it. Hi everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, funds, and investment rounds. Let's jump into it with our guests for today. Al-Qattan, principal at Dash Ventures, Tambi Jalouqa, founder and general partner at Maza Ventures and co-founder of Xpand Conference, and my co-host Jamie Lane from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Tambi, can you please give us a quick brief on the Xpand Conference? It's happening in less than a month, right?
Yeah, it's happening on the 4th and 5th of October. And not much time left, so here it's like really busy. It's just the biggest gathering of software and product people in the MENA region until today. Of course, always looking for more conferences to attend, not to organize. It's where we bring in like 1,500, 2,000 people that are building, AI, other products. They're part of the value chain, a really important part, which is the actual engineers that build the products. And yeah, we give them good talks. We bring them together and allow them to network.
This episode is brought to you by Octa, the AI-powered finance automation platform built for modern businesses. Managing receivables is not one task. It's dozens of repetitive ones. Correcting invoice details, updating PO numbers, following up on payment status. It's operationally critical, but painfully manual.
Octa changes that. It helps you automate your financial operations, starting with accounts receivable, so you can focus on what you're actually good at, growing your business. From contract to cash, Octa's AI agents handle everything: invoice creation, reminders, dispute resolution, payment tracking, reconciliation, even financing. You don't need to learn how to use Octa. Octa learns how you work. It adapts to your SOPs and existing workflows to get the job done. Finance teams at Careem, Lean Technologies, and Outgram rely on Octa to reduce admin time, speed up collections, and unlock cash flow.
If you've heard of them before, you know that they used to say 100 companies use Octa. The number is now 500. They are moving fast. And that kind of growth only happens because the problem is real and the solution actually works. Automate the finance work that slows you down. See how at weareocta.com. Jamie, what's happening?
It's an extraordinarily busy week. It seems like every time actually I do get sick and I come down with a man cold, it tends to be the busiest possible week from a news perspective, which is just typical. So sort of a bellwether for when everyone decides to announce everything. Property Finder, I think, is the logical place to start. Although it's difficult to discern, like there's so much this week, there's so much we've actually left out that we're not even going to get the opportunity to touch on just because there's so much to sift through. But I think Property Finder is an interesting one. As you mentioned, the introduction, Ahmed's been around now for quite some time, 13 years on the go. In fact, started in 2005, I believe, as sort of a more kind of a property magazine, wasn't it? Before then transitioning sort of into the classifieds approach.
I didn't know that.
Yeah, as far as I'm aware, sort of repositioned in 2007. It has a long and checkered history. It's very, very, very interesting. And obviously last year we had its first institutional investor in Beko exit at a $1 billion valuation. But as you mentioned in the introduction, it hung around for another year, 2 billion. And look, I mean, with the markets out the way they're at the moment, I mean, I think it would be no surprise to see that edge further up when it eventually does IPO, which seems like it'll be some point in the next 2 years. To that end, Amir Farah, now of Co2, formerly of Beko, has penned a very, very, very good article reflecting on Property Finder and the journey as far as that's concerned, and also very transparent in terms of figures and metrics and exits. Obviously,
When was it published?
it published only, it actually republished for start tomorrow. So I was in touch with Amir, so we'll be publishing it there, which is great. But in terms of, I suppose, the Beko situation, it sort of seems like it was just a point where they needed to return the fund. I think it maybe been 12 years. But he's some very interesting reflections on when the right time to pull the trigger on that is. If you wait a small bit longer, invariably, maybe it's a 3x on where it is at present. But it's very interesting. As it was, it returned over 80 million to Beko's LPs, and it was a 1.6x return on the fund. So, I mean, it's still mightily impressive. But I think it raises interesting questions now that we're entering into this phase where more companies and more startups in the region, hopefully, will be going public. When do you time the exit? Impact 46 with Razan, for example, they exited very speedily. I think once that lockup period was over, they were out of there. But it's a question of timing. And, do you try to time it? Not public market investors, or do you hold on? What do you do? I don't think it's something we've had to properly contend with, really, before now.
Yeah, I have so many questions. But maybe let me start with the most obvious one. Real estate portals and classifieds have been there forever. What makes Property Finder still interesting and at this scale today? Is the next play mortgages, data, or just defensibility through the brand and reach they have? What do you think? Why is it still interesting today?
In general, I think the industry itself, in Dubai specifically, has not only heated up, it's been hot for a long time. You have Keeper there as well. That's continued to scale. It's a lot earlier stage than Property Finder, obviously, but this is the reflection of just greater macro Jalouqa, right? Like, people continue to move to Dubai, specifically higher net worth individuals, and acquire property there. And so long as that remains consistent, which there's no reason why it shouldn't, companies like this will continue to perform. And it makes sense. And the reason I think Property Finder stands out amongst the rest is that obviously they've built a very sticky product, and one that I'm sure has strong retention numbers and repeat user numbers. That's logical given the fact that it's been around since 2005. So once you develop something that customers can't really get rid of and they feel loyal to, this kind of scale is likely. I'm personally invested through NX investment in Keeper and in Ijari, because I do believe that both in Saudi and UAE, there's going to be continued potential in Proptech as a whole. But what I think will happen is that, similar to Property Finder, whoever kind of dominates the data play early will then be able to offer their customers ancillary revenue streams, like whether it's lending or for tenants, landlords, and any kind of product that facilitates easier transactions or more visibility within the space that typically was archaic because it was so reliant on government schemes maybe for a long time. I think the space will continue to grow, and it made a lot of sense. First, what Beko exited, I think at the end of the day, I know you wanted to ask a question about it, Ahmad, but the truth is every VC will give you a different answer based on when their fund was established and what kind of DPI they distributed to their partners so far. If Beko was in a position where they needed to return capital, then it makes sense. Obviously, in hindsight, you can look back and say, oh, how did we waited on for a year, done 3x? But you never know. Cash is king. Get that money back to your LP so that you can justify raising follow-on funds, larger funds, and continuing to invest on the value chain. So, easy to sit here in my seat and like, oh, Beko should hold on. But I think in a similar position, we're not, right? We're evergreen. We're a bit more patient. But if I was in a situation where returning capital to LPs is very important, then I would absolutely make the same decision.
I agree. And I don't know a lot about the Proptech in specific, but I know that it's large in our region, especially Dubai and Riyadh. And it's one of those, let's say, two pillars where 80% of startups in the region are Proptech or FinTech. Just an assumption. I don't have the actual numbers, but I'm sure it's going to be something around that. So from my end, because I don't know, I'm really curious about how much value does Property Finder and the likes generate? What's the run rate, the annual? Do we have any of those numbers? I would love to learn. Once they go public, maybe that's a new piece of information that we can start analyzing, because as you said, we're all new to this IPO game, tech IPOs. It's not something that we don't have historical information. You can go and read all the S1 filings from, many years in the US, but in our region, we actually need to learn how does this work. And from my end, I don't even know how a property finder grows. Does it grow in different markets? Maybe they do have different markets. Actually, but today is the first time
Yeah, they do. It's now a group. I think they're operating in like 9 markets. Jamie, correct me if I'm wrong.
it's all classifieds and they connect.
Geographic markets, but it's the same thing. It's classifieds for real estate.
But Tambi brings up an interesting point, which is not interesting. It's just something I was going to talk about it when we got to noon, but it's relevant now. Is that when a company goes public, it's like the first time they no longer work for only their board members and themselves. They're working for them shareholders and the transparency around numbers becomes something that they can't get wrong and they have to do consistently. And it'll be, like Tambi suggested, important for us all to learn what works and what doesn't, and hopefully encourage more startups to go public and perform well in the stock markets, both in the UAE and in Saudi.
Do we know their revenue numbers annual?
No, I don't believe we do, Tambi, no. In terms of geographically speaking, they do currently operate, I think it's UAE, Saudi, Qatar, Bahrain, Egypt. I think with this particular round, they're looking at Turkey as well as an expansion market.
Yeah, but that's one interesting thing. From my end, I'm going to dig deeper. I did ask ChatGPT, it told me 100 million, but I'm not sure. It could hallucinate.
Abudi, let me go back to you on Beko and the decision to exit at that time. I know they had to exit because maybe the fund term ended. But in general, is there any innovation in this area? Like maybe can VCs create a single company opportunity fund for such companies so that they can extend the holding period, or maybe distribute shares back to LPs?
Yeah, there are continuation funds, right, that are set up specifically for this, but I believe that requires full LP approval. And when you have a fund like Beko's, I'm not sure how large the fund was that it returned. You said 80 million, 1.65, so you know the range. You imagine that there are quite a few LPs in there, and if depending on the articles of association and terms between the LPs and Beko, certain amount of VCs or LPs could just say no and want their money back, and that's how it would work. So I think in general, given, like I believe Jamie said, 12 years since the fund had started, the expectation is that most LPs get opted to receive cash back. And I think while continuation funds do work in some elements, again, I would understand why Beko it's more.
Tambi, you're a very early stage investor. You've invested in so many angel rounds. How do you see the future of VC exit? Not necessarily the company to exit, but as a fund manager, how do you see that in the future in MENA? Do you think secondaries will play a role in here?
I definitely think secondaries, which is a huge part of a lot of early stage VCs strategies going forward, which includes mine, by the way. And when you do pre-seed, seeds, you are open to secondaries more than IPOs just because of the timing. Because at some point, yes, you cannot hold forever. You need to generate those DPIs, which bring in good IRRs for those individual LPs. And you do need to sell. Do you sell all or not? That's usually what I think is going to happen. By the way, don't forget, especially me, I'm new to this, so I still don't have a full fund life cycle. This is what I'm assuming I'm going to do. But most probably is bring in most of it in cash, like 75%, and keep 25% just in case that could eventually bring in the same as the 75% if the company has a chance.
We're actually looking at doing something very similar at the moment with a company in our portfolio. It's like an opportunity came our way, and we're considering returning at least 2-3 for whatever the number turns out to be, corrects the initial capital, but then leaving in, I think it's like 30-40% for potential upsides. It's also a smart strategy. Again, I think it's just contingent on what the priorities of the fund and the GPs and the LPs are at any given time.
And most probably that 70%, 60% is going to go to a secondary buyer, right? Which means there is room for a secondary market. It's going to increase. It's increasing globally. And at Propeller, my previous fund, we did 2 secondary deals. So yeah, 2 out of 3 actually. So it does make sense.
For my last question on this story, this company spent 13 years building, and now it's valued at $2 billion, while newer companies are hitting this number way faster in 3 to 5 years. Why do you think older startups grow slower in value when the new ones, are exceeding all of these expectations, although the old ones are running solid businesses. They've been there for 13, 14, 15 years.
I think solid is, solid grows slower. That's usually the case. Anything similar to real estate, similar to all the other asset classes, where those startups are more similar than someone who's moving fast and breaking things, maybe similar to what I think Replit yesterday, they announced 3 billion and they do 150 million in ARR, as far as I remember. They're moving faster. This took them, I'm going to say 9 years, maybe, to achieve those numbers. Yeah, when you're working in tech, you move fast, things change, you adapt to what's happening. I think in property, real estate, and those kind of businesses, they move slow because nothing changes in the behavior. Like, people didn't used to ask ChatGPT for things, but buying a property is still the same. I think maybe the last 100 years, maybe classifieds change it. Instead of opening a newspaper, now you look at the website, but I don't think intrinsically the act of buying a house or looking for a house changed. That's just my opinion.
But 10, 15 years ago, these companies were the new tech companies, or the companies that bring tech into industries like real estate, where tech was not really used that much.
There wasn't a market in the Middle East, so that they didn't have the opportunity to grow as fast as some of the startups do today, which makes it all the more impressive, and either were or inch towards profitability over a long period of time. And the trick is, a company like this probably really understands its market, understands its customers, and that's why it's stayed around for a long time. I don't think it's representative of anything other than a strong, solid company like Tambi said. The fact that it's growing at these rates, right? At the end of the day, it is a game of when the market itself adds to the opportunity you're building, you're going to grow a lot faster. But it's not necessarily a good thing. We've seen a lot of companies that do scale to valuations in 3 to 5 years and then not maintain it. When you have to play catch up to your valuation, if you don't have strong fundamentals, at the end of the day, it stunts your growth, and you end up being one of the things we talk about in podcasts like these, which no one wants to hear or do when companies scale that fast. But I think it's just a testament to the founders. I don't know them personally, but I would say it's a testament to the founders to keep the company around that long and to continue growing. And now you see, by the way, what from 1 billion supposedly last year when Michael exited to 2 billion this year, that is rampant growth. That's 100% growth in a year. So it's not that boring if you ask me. He told me I could invest in a company that's going to grow 100% a year every single time. I'll tell you, you know what? That sounds like a good idea.
Did they grow?
Did they grow? Yeah, to justify this valuation? I don't know. I think they already grew, but maybe the valuation was not fair to them in the first place. Now it's becoming more fair or in bar with what's happening in the market. Maybe, I don't know.
I think that's what Amir
I see the
suggested was most likely that billion valuation was at a discount in reality versus the actual valuation. I think he mentions it's
if they sold via secondary, there was. But I think the article said they raised 90 million in debt. So
they did, yeah, exactly. But I think he mentioned the company is still growing something like 20 to 30% year on year, and I believe it's profitable as well. So I mean, to your point about it, you'd happily invest in said company all day long.
So that's another point. Would you encourage your companies or the founders of your portfolio companies to take a loan to buy out an existing investor?
If the company held a strong cash position and could, handle the interest, then why not? Why not? And all 4 founders finding innovative ways to not dilute themselves so they're very incentivized going forward.
That's like their treasury, let's say, person, whoever is it cash? Should we finance this buying out existing shareholders? At that point in time, if you're doing that much revenue and you're comfortable, you're almost profitable or profitable, you have those options.
Okay, let's move on to Noon. What's happening with him?
Yes, so Mohammed Al-Aber, he is the man behind Noon, also chairs Imar Properties. We've been to Dubai. You'd have seen their buildings. Impossible not to. But in any case, he's given quite an interesting interview to the Financial Times where he's disclosed some information, some metrics. So, and he also cites that Noon is looking at a potential dual listing between Saudi and the UAE as well. So he's touted that, which is interesting in and of itself. He's also disclosed something toward the valuation, which is close to $10 billion. They've raised 2.7 billion.
That's the current valuation, or what's they're aiming for?
Unclear.
Okay.
I'll give him a call.
My
I'll
understanding
give him a call
was they're
after.
targeting a 10 billion.
I'll give him a call after and I'll clarify. I don't know whether he'll take my call. But yeah, I mean, they've raised 2.7 since 2016. So look, it's quite a bit. In terms of other tidbits from the interview, almost profitable. He mentions autonomous delivery vehicles, self-driving vans, three-wheelers, all the things you would expect on one level. And then casually reducing drivers by 50% by 2027 would be amazing, he noted. It certainly would. But look, stiff competition. Noon is interesting as well in terms of, I mean, it is a commerce super app in many respects to rival Amazon to a certain extent in terms of the UAE, in terms of offering there, and also on the food delivery and quick commerce side of things as well. It has
Talabat and
it has a payments
and
functionality
PlayStation.
as well, similar sort of to Careem in many respects, as the services like a Just Life. So it's I think Red's here estimate its GMV in 2024 something close to 5 to 6 billion, something to that effect. So it's an interesting one. Dual listing approach. Interesting to see how that plays out.
What do you think about that? Talabat went public in the UAE, in Dubai financial stock market, was successful IPO, as far as I know. The stock price is not changing much now, but it was a good IPO. Do you think they should go follow that lead and list in Dubai, or do the dual listing where, in Saudi we have Jahez, we have Rasan, we have the nice one, all of these tech IPOs in Saudi. What do you think? Which market has deeper pockets or deeper liquidity?
I don't think it's a function of deep liquidity. I think everyone knows that Saudi most likely has more liquidity, but a large part of Noon's business is the UAE. I use the quick commerce section. It's fantastic. You can get a range of things in a very short amount of time. And what they've done is exactly how a company like this is going to eventually achieve profitability. Is you dominate the market by probably not making too much money and losing money for a while, but you make sure you've got a lot of drivers, a lot of products, and very convenient locations, that your delivery is excellent. You make sure you've got customer service. And if you manage to beat out all the competition and you manage to continue raising either equity or debt, you start to add ancillary services like financing, like payments, like what we talk about, autonomous cars, and you optimize. So if they're able to do everything they say that's in their product development roadmap, then you have a real winner here. It's a very difficult space to dominate, but when you get it right, it's extremely lucrative. And that's the goal we as Dash are also trying to have a similar play with Postex in Pakistan and Saudi, just in terms of the logistics and fintech balance. When you operate in a market like Pakistan, you can be profitable there, and Postex is, and then you come into Saudi and UAE and you take a different approach without obviously, sacrificing too heavily on the margins, but you do try and add some, again, like I said, ancillary revenue streams to complement what you already built on the logistics side. So it's a remarkable company. The $10 billion valuation is no joke. I hope, they get to achieve that. In terms of the dual listing, I think, like I said, part of it is because the UAE has a large operation in terms of what Noon offers, but also it's a way of splitting risk, right? Seeing how the market responds in two of your key markets. And, just because you dual list at some time doesn't mean you can't offer more service at a later date. So I think it's a chicken idea.
Tambi?
Again, something that's not within my alley, but I do have some thoughts. So the best place to list usually is the US, right? That's what anyone who has the ability to do that, has the actual numbers, has the actual profitable business that should attract people, goes to. Second is Saudi.
I would challenge that part. I'll let you finish that thought.
Yeah, second is Saudi, and then it's the UAE. And from where I'm standing, it feels like it's an Emirati, appeal to being both in it feels Saudi makes more sense from what I know, and the UAE is more like, because they've been a part of the UAE story, so they want to continue being part of that and access the market makers in the UAE, and that's why they do a listing. But also, I don't know. I don't know what other companies do listed, by the way, in the region. That could also help us understand what's going to happen and what happened there.
On the listing in the US, I think we've seen some companies from the Middle East listed in the US, and it was not really good on the long term, let's say, versus what happened with Talabat, and Jahez and Rasan and the nice one. Listing locally where your business is sometimes give you an advantage because both institutional and retail investors know about you better. Yeah, go ahead.
Can I ask how much did the Jahez stock grow since listing?
It in fact
We can check.
reached its lowest point ever yesterday.
Oh wow. Okay.
Yeah.
Just the data.
As a percentage.
Yep.
As a percentage.
Oh, as a
do you know
percentage, how much it's down? I don't know. I just know yesterday was yesterday was the low, all-time low.
So it might have been good for the VCs, but is it good for the retail investors? I don't know.
Do we have better examples with, I don't know, Swivel, Anghami, with all of these that went public?
Same with Anghami. Sadly, they jump over the.
Well, so also, I will jump in here and say that the company is actually performing quite well at the moment. And even throughout all the backlash and public sort of rhetoric around Tambi, Mustafa and Yusuf Sarah have continued to execute and in stores and then blast across profitability. Company's growing, things continue to go well. He's communicated transparently throughout the entire process. This was honestly, in my opinion, it was just a company that was on track to be ready to IPO at some point, but IPO too early and did so at the height of this reverse SPAC nonsense fueled by people like Chamath, honestly. And it's the truth, right? The guy went out there and told us that we want violence. It's complete crap. And good companies have swivel, though it's not fully his fault, suffered because of the general craze. But that's the founder and the rest of the team deserve all the credit in the world because again, a simple Google or LinkedIn search will show you that the company is performing very well. Again, transparently, it's a public company still in the US stock market, so all these numbers are vetted and verified. And I really believe that I had to jump in there and make that clarification. I mean, I don't know the details, right? But while some of these companies haven't performed well, I just think that it's like a faucet where you slowly turn it and slowly turn it and slowly turn it, and eventually it just will. Given how many exciting companies are teetering with the idea or have publicly made their intentions known, like Tambi, to go public at some point in the next couple of years. So I remain bullish. I think Tambi, you do too, otherwise you wouldn't have raised the fund and good times ahead, inshallah.
I'm more excited about local IPOs, to be honest. Hopefully we'll see this more soon.
By the way, I am excited and I do believe we will have good IPOs, but I'm just questioning like dual listing and how should we think about it and which market is better. Yeah. I believe retail investors in Saudi have more liquidity. So most probably that's the market that will generate better IPOs. That's just my opinion. And I couldn't understand why the dual listing. And I still don't have any historical, although I'm not a public equities investor. So I'm sure other people who have more experience can give us insights.
Great. So let me move to another aspect of this story. Al-Abbar said the world doesn't accept Amazon-style losses anymore, and he wants to create a profitable company. And he made it a public statement that he wants to make Noon profitable before going public. But at the same time, he's expanding, and he mentioned that he wants to reduce the number of drivers and use technology to enhance profitability. So maybe two questions here. One, is that realistic, given the current status of the streets, the environment in the MENA region? Are we ready to have autonomous vehicles do that delivery? And second, he mentioned that he wants to expand to India. Does expanding to India help in profitability, or is that even more of a risk to spend more?
I highly doubt that expanding into India would. It's not like the purchasing power is much. Okay, the population is, but I don't think that per delivery the unit economics will be better in India than in the UAE or in Saudi. And I don't think that the infrastructure, although it's an amazing country, but the infrastructure that allows for autonomous delivery and these things sounds so much more systematic than what India is because of its vastness and like the way the country comes about. So doesn't feel that way. Could increase the top line for sure, But profitability, I don't see how. Maybe I don't have the.
How about in MENA? Can autonomous vehicles operate in MENA?
That's a different problem that I don't think Noon should solve. We should have like 3-4 companies similar to how Waymo, Cruise, Tesla, all of these ones working on that, and then they would collaborate with Noon. But I haven't heard of one single company that's working on autonomous driving. Maybe there is, but I haven't heard of one. So I'm calling bullshit on this strategy.
Okay. Abudi?
I wouldn't go that far. I agree with Tambi in the sense of like they would have to rely on third-party provider for the cars. I personally don't know of any that are producing in locally, which would mean getting them shipped in specifically branded right would be quite cost intensive. But in principle, yes, I do think that moving toward autonomous vehicles in an ideal world in the region would help them with profitability. I think India, I agree that there's no way, at least some of the places that I've been to, that autonomous vehicles would function. But I do think, let's not sleep on the Indian VC market, right? There are plenty of tech companies that have sort of scaled rampantly and that have strong economics. From a cost side, if you don't go with the autonomous drivers there, then regular drivers there are definitely cheaper than they are on the Saudi. And then there is, it's probably not that large, but there is still a community of high net worth individuals in India, people that have made their money in the tech market or in very early days in India and family wealth and generational wealth and stuff like that. So you never know. I won't speak on a market that I don't know very well, but I think in principle, like Tambi, I'm hesitant to believe they can execute both strategies at the same time. But if they did, then that would definitely make for a compelling case to help them towards profitability.
Okay, great. Well, moving on to the next story, and let me explain something here. We don't know what news we will discuss with the guests that are confirmed on a specific day, but we feel so lucky whenever one of the guests has invested in one of the companies we're talking about, and we have this example today. Jamie, tell us more about this.
Oh, Booty definitely knew. I knew.
Maybe you want to talk about the company first, and then we'll let Abudi lead the discussion.
I chatted to Nevin like a month ago, so I mean, I knew as well. But in any case, I just published an interview with him this morning, which was great. So, Orbii, they raised a $3.6 million seed round, backed by, of course, Dash Ventures and led by Process, which is interesting in and of itself, considering they generally invest at the Series A stage, which I think is indicative on one level in terms of where Orbii are at. We also have Venture Souk, so we have the fintech OGs in there, Taz Investment based in Saudi, and obviously Sanable 500 as well. Super interesting startup, super interesting story as well. It's a massive gap. I mean, it's something like a $340 billion financing shortfall that they're addressing here. And the premise, I think, is pretty simple. The credit scores no longer reflect reality. That's what everyone told me. So Orbii uses kind of live data, hypercontextual models, embedded workflows, essentially just to help lenders evaluate SMEs in minutes as opposed to weeks. But I'll defer to Booty, who has the inside track on all of this. What was so attractive about Orbii?
I'm smiling because I love the deal. A couple of things. First and foremost, the founding team is excellent. Ex-Microsoft, ex-Tesco, ex-Bank of England, GDPR experience. So, this perfect blend of data, AI, machine learning, and things that are really important. We're trying to build a very fast, efficient, comprehensive model for SMEs that are typically unscored or scored incorrectly. What we specifically like about the way they approach the opportunity is we have a lot of experience in lending, right? And within the actual, transfer of funds. And while there are opportunities there to make money on interest spread and then again develop other products, this really asset-light model spoke to us in a number of ways, right? It's essentially an embedded fintech play because it's not only for fintechs. Yes, the initial ICP is B2B lenders. So not only banks, they do work with banks both in terms of partnership and in terms of customers, but the ideal customer is any B2B lenders. So you have companies that are essentially marketplaces that have buyers and sellers, and you could essentially embed into their service offering the opportunity via API to receive a loan, and then Orbii was scoring. So we like that. It's scalable. It doesn't rely on debt. They don't have to do any of the physical lending. And I think that is something that allows for you to also maintain extremely attractive margins and grow efficiently without needing at least we don't foresee the need for extensive capital raises, which with the VC add-on is nice because that means I don't get delayed. I can continue to add my position, hopefully, if we remain, and I expect we do, in good spirits with the founders. Again, like I said, we're great people. The early traction was extremely impressive given how little they had raised so far. Jamie, I'm sure you can echo this, but Nauman himself is a remarkable founder, very poised, confident, but also balancing, confidence and humility, which thing we look for specifically at Dash. And just when we feel like we can add value, given the relevance of like fintech and our relationship with Capital Bank at Dash, we like to take, to be a part of the journey. But ultimately, we are also grateful that they had been close to closing around when we got introduced to them from process where we met Robin in Dubai and he made the introduction. We're done. So, and like I said, the farming team is remarkable, and we're grateful to be on the cap table with other great investors as well.
Jamie mentioned the interview on FWDstart with the founder. And in that interview, I think he mentioned that he created a list of investors for updates, like 2 lists, one for investors, and then the other one was Orbii friends of Orbii. Were you on that list, Abudi, before you got introduced to the founder?
It's funny, so I have to hold my hand up and so I need to be a little bit better, but we typically only get pipeline and take a really serious look at it if it comes from someone that knows us well and that knows what kind of value we like to hire and also knows where we like to get our hands dirty. I got a cold email from Nauman like a year ago and I saw it and I remember I did note it and speak with Ahmad about it and say this is interesting for lending, but we were both like, it was earlier as well, so the traction wasn't as relevant for the kind of thing we invest in, but I passed quickly. So when Robin brought it up in our meeting in Dubai, he said Orbii. I'm not remembering the name specifically because it's spelled with 2 I's, and we got reintroduced. So I was not a friend of Orbii list, but I was aware of the company. I didn't impress when I first approached us. And sometimes these things happen. You think it's fate, right? Like we could have easily missed the opportunity. The next time in principle will raise, it will be, unless we're already on the cap table, will be too late for us for an entry ticket, most likely.
This idea of having a list of target VCs or angel investors, and then you send them monthly or quarterly updates on your company. What do you think of this idea?
I personally love it. It did work for a few people. I'm not sure if it's email or sending LinkedIn messages, but yes, some people were able to convert, like, let's say, Propeller into investing in them through actually outreach, sharing what's happening authentically, by the way. Not every message looks like spam. Sometimes it's just, hi guys, we're still doing this. We hit this. We would love to talk again if whenever time allows. And some of them, those are check-ins, more coffees, like let's go out for coffee. I'll tell you what's happening. I know that you passed on us before or you weren't excited. And I want to rejuvenate that or create that excitement. For me, it's fair game. And I think it's a good thing, these lists and keeping people interested.
Back to you, Abudi. I know that at least one competitor that I know of for Orbii, which is Abwab AI. Is that really a competitor? And have you considered that company before investing in Orbii?
We didn't engage with Abwab. We've heard of great things about the founder, and apparently he's super sharp. But you said it yourself, JB, this is an enormous space. It's not a one winner takes all. And again, I really need to speak to the testament of the founding team at Orbii, and that's what essentially built our conviction is they've done it before at a higher level. These are no small enterprises that they've represented in the past, believe in their ability to dominate the market. You see, when you target, it's an interesting play. I've referenced on this podcast so many times how we are typically very patient, and for us, given our structure as an evergreen fund, we don't necessarily always look for quick 5 to 7 year returns. But in this case, we do feel like the opportunity will be taken over in the next 4 or 5 years. When you're targeting with B2B lenders, there aren't that many, but when you do secure them, the contract value is typically pretty high and sticky, especially if you build a sticky product. And they have so far, and if they continue on the scale, I think we'll know, hopefully, in the next 3 to 4 years, if we back the winner. And I don't say B winner, I say A winner, because they're, again, like I said, there's space for multiple players, in their specific segment of lending.
This company provides technology solutions for the B2B lenders. Multiple companies trying to do this. And they built their own technology, right? Because they consider this part of the tech as a core competency of the company.
Yeah.
Do you think startups who are offering lending, B2B lending, should depend on a third party for such a technology or build it in-house?
First of all, in 2019, I did actually invest in a company that does risk analysis and credit scoring for lending. That was in 2019. They've pivoted later on, and it was actually a really good exit. So it's like our biggest exit. So I do understand the problem and why do people work on it. And I think it is something that could be exported because it is at the end infrastructure. It's like, we need to do some analysis. We use software to do that, which is what I'm assuming Orbii does. I think there is a space, but I caution like that if the lending book of your customer grows, there isn't a direct impact. Then you're selling software, so you need lots of customers. So that's an area I'm interested in. Like, is it only Saudi? It's a global play? Usually in things like this, you want global plays because, you will become a vendor. You will become a list of the tools that lending party uses. And you want to be careful of increasing the number of customers. That's
But on the startup side, like the lending startups, should they use them as a vendor or build their own in-house?
should they use them as a vendor? I think a lot of times you should build because what you're offering is the actual debt. And that's the thing not the selection process or identifying which is a good receiver, beneficiary or not. I think that's something you can buy in the beginning. Yes, you don't need to have it built in-house.
Okay. Budi, any comment on this? Like Irad,
Look,
like
Irad's
Irad
a
and
great-
Capify and all of these should use Orbii or build their own in-house.
Look, they each do it in their own different way, and it makes sense for them, some of them, to want to own their own IP and to build their own credit engines, and that's expected. We're not trying to sell to everyone. But at the same time, if you operate a company like that, and there is a company like Orbii, and you feel like they do a quote-unquote better job, then there's no shame in using them, right? At the end of the day, you still have control over securing debt and allocating funds. So I think Orbii provides recommendations, but ultimately you don't have to list. Like Orbii will tell you maybe, this customer is in this and it's a duration, but you should consider lending. But as a Irad and as a capital fund, you can still determine based on your fund and based on other factors how much to lend. So there are times when Orbii will replace companies in their own tech, and there are times where the company won't even engage with Orbii. That's just part of the game.
Abudi, thank you so much for being with us today. I know you have to
Pleasure.
leave us for a hard stop, but we will continue with one more topic.
Pleasure. Enjoyed. Ryan.
Cheers, dude. Thanks a bit.
Thanks, Abudi.
Take care.
Of course, see you soon.
Okay, Jamie, we have one more story for today.
One more story
Tell us
for
more about
today. Yes, more growth funds. God, you can't
Yeah.
keep up. This one is interesting, and it's being spearheaded by someone who's not new to this in terms of establishing a fund regionally, and that's Dominic Perks, who previously served as CEO of Hambro Perks, who led the launch of RX Fund, who I'm sure many listeners will be familiar with, $50 million fund, focused on fintech, health tech, edtech, etc. Dominic stepped down in April 2023. The firm since rebranded to Takatkah Investments, and now he has launched Lexum Partners, and it's a $200 million growth fund in conjunction with A&B Capital. They mentioned a couple of different things. Much to your delight, Ahmed, they mentioned secondaries. Is it going to be a core part of what they're doing, as well as equity as well, and specifically cite Saudi as I think they're the sole country that they earmark regionally. So I think that maybe provides you with some sort of idea. And obviously the fact that Arab National Bank isn't involved as well. It's unsurprising that maybe the mandate is a bit more narrow.
The more capital, that's good. More opportunities for companies to grow, to have access to capital. Yeah, good news.
Yeah, we always hear the lack of growth capital in MENA. And the founder of the fund said, this is a golden era for growth investing in MENA. But I'm just questioning how many companies are in that category today? I'm sure they're building for the long term and more companies will show up later on. But for today, do we have enough growth stage companies and attractive growth stage companies to invest in?
There's like only 10 Saudi, let's say now, growth stage companies, candidates for IPOs, which is a good, a good strategy for a pre-IPO fund, which I feel that's what they're going after. I'm not sure if they're going to do a Series Bs or pre-IPO. That's not, or at least I couldn't read it anywhere. And yeah, if they're going to look at the Series Bs and Cs, I'm sure they will find companies, but I don't think there are a lot of companies that are growing super fast in that, to my knowledge. But yeah, I'm sure they thought things through. It's always good to have more capital in the system. Personally, I prefer for that capital to go into the pre-seed, but that's just my preference as a VC.
My concern is just that because of the low number of growth stage companies, attractive growth stage companies in the region, and now we have a few funds that are targeting them, there might be some competition that might drive valuations up.
Okay, so you've just unlocked Tambi.
Okay, go ahead.
Yes, there is too much capital chasing too few deals, and with a mandate to invest that where the actual mandate is driving the investments rather than good opportunities on the ground. So I do feel that, yes, there are problems that are being generated. We are getting some cancerous cells in a few pockets on the region, and we should be careful about how we spend that capital, although usually it's good for companies. But again, the way it's being pushed, the way that those large funds can't be like, this year we're not investing, because they're measured by how much they deploy, not by how much actual returns they generate. So that is concerning. But of course, it's also good to have more capital. So I wouldn't say that we don't want more capital. It's just how that capital is dispersed is something we need to be careful of.
Yeah, and those global GPs are coming to the region, which is good. The region is attracting global GPs now, where they bring some funds with them and they raise locally from local LPs. And this is, of course, this is really good for the region and for the startups and for the LPs.
Yeah, but it's also too easy to just identify the winners, because the winners just, our spotlights are highlighted on them. You just put any check in a winner, and it's a very easy money to be made. Although we do need the capital, but yes, we have to be careful about who we hand that capital to manage. Yeah. Sounds weird to say that as a fund manager as well, but it also affects our companies down the line. So I do hope good diligence and selection is used when bringing in the new fund managers into the region.
We've seen in the MENA region a lot of mandated capital by the sovereign wealth funds and programs who want to create more jobs and more businesses inside their countries. As we talked about maybe before, this capital will limit the returns of the local GPs. And when we start now comparing global GPs coming to the region and the local GPs, there would be some mismatch, especially because those global VCs are free to invest in whatever they want, but for the local ones, they are mandated to invest in specific countries. What do you think about that in general? And I know that you suggested a new business model for mandated funds. Do you want to share that with us?
Yeah, totally. Mandated capital as a core principle makes total sense. You want to grow your own home country, and you want to attract good people to invest in it, to help you grow those local companies, SMEs, startups, whatnot. But the way you do that should change, in my opinion. So although the premise is pure and good, but the way where it affects especially local VC funds is kind of detrimental to the VC industry. And if the VCs are not doing a good job, doing good returns, you're not going to have much more VCs or good VCs. Similar to a startup, by the way. And at the end, people forget that a VC is a business.
You're not investing your own money. You're managing
Exactly.
money on behalf of your LPs,
So you need,
who are also investors in your own company.
exactly. So you need to do a good job. So the thing is, mandated capital, the way it's sometimes suggested, or the deals that are brought into VCs push other LPs away. So once you take mandated capital, other LPs are like, no, this fund is tinted. Contrary to what people think. People think that, yeah, if mandated capital is in, it's good. It's not actually. It lowers the returns. So what people need to take a different market risk. Usually VCs don't need to take that market risk, but they're forced to take it. And it's actually tied to the way they do operations, because that's how they're judged. Part of their judgment is not only IRR, it's also developmental. So when you mix both, the LPs that ask for that local developmental return need to take a first loss kind of mentality and make less returns on that capital. And I believe that that capital should be distributed to the other LPs that were in this fund, and they know that a portion of this fund is going towards this market. And that's why they're actually making more on the backs of the people who want more local development. Does that make sense?
Yeah, so you're differentiating between the financial return and the development return of the fund. And you're not asking anything for yourself. You're asking for part of the financial return to go to the other LPs that are not concerned a lot about the developmental return, because they're not the sovereign wealth funds, they're not the local programs trying to develop the country. They're in it for the financial returns. So you want to take part of the financial return from the developmental funds and give it to the other LPs in the same fund.
Exactly. Without touching it as a GP. I think that's one proposal that I'm proposing to multiple funds in the region.
It's very interesting. Well, before we wrap up, a big thanks to Octa for sponsoring today's episode.
If you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com and take control of your accounts receivable today.
With that, thank you so much, Tambi and Aboudi, who had to leave us, for sharing all of these insights with us.
Thank you, Ahmad, and thank you, Jamie, and get well soon.
Thanks, Avi.